Welcome back. It's Finance Friday, another special edition of Money Girl where I answer your burning money questions. Today, we have a great topic from Kareem, who says, I understand that tax rules change every year. I'm curious about any upcoming adjustments or new regulations that could help me save money. My question is, how will my taxes change in 2025? Thank you, Kareem. That's a great question. And yes, the Internal Revenue Service, or IRS, makes various tax changes annually to account for adjustments in the inflation rate. This podcast will review several upcoming tax adjustments for 2025. With some strategic planning, you can use these changes to cut your 2025 tax bill and save money. I really appreciate you joining me to listen to episode 887 of the Money Girl podcast. I'm Laura Adams, an award-winning author, finance speaker, money spokesperson, and consumer advocate. Please reach out if you're interested in collaborating for a speaking event or PR campaign. As always, you can reach me using my contact page at lauradadams.com. That's also where you can sign up for my free Money Stack newsletter. Subscribers get my free Money Success Toolkit, which includes a financial planning workbook and personal financial statement calculator to assess your financial situation, set goals, and track your wealth. A great thing to do as we approach the new year. And I'd love to feature your money question on the show. You can send it to me by email using my contact page at lauradadams.com or by calling 302-364-0308 to leave me a message. So according to a recent IRS notice, more than 60 changes will affect taxpayers when they file their 2025 tax returns in 2026. But here, I'm only going to cover the 5 most notable updates that could make the most significant impact on your finances and your potential savings, which is what Kareem is asking about. So let's go through those 5 changes that are going to be coming in 2025. Number 1 are changes to workplace retirement plans. The IRS announced higher contribution limits for some retirement plans in 2025. For example, if you have a workplace plan, it could be a 401k, 403b, or a 457 plan, the maximum will increase to $23,500. That's $500 more than for 2024. But the additional catch-up contribution that's allowed for participants over age 50 will remain the same at $7,500. So that means next year you will have a total of $31,000 for maximum contributions if you're over age 50. However, there is a new regulation that I spoke about in a previous podcast that will allow older participants to invest even more in their workplace retirement accounts. We're calling them super catch-up contributions, and they only apply to workers between the ages of 60 and 63. For 2025, if you're in that age range, you can contribute $11,250, so that will be your super catch-up for a total contribution of $34,750. So that's made up of $23,500 plus $11,250. So using these increased limits to boost contributions to a pre-tax traditional retirement account means you reduce your taxable income for the year. For instance, let's say you earn $100,000 and you contribute $20,000 to a 401k. In that case, you only pay tax on $80,000 of income, not on $100,000. While you don't receive an upfront tax benefit if you contribute to a Roth account at work, they may save you more over the long run, depending on your future tax rate. For instance, let's say you pay an average tax rate of 20%, but you expect your tax rate to be 30% on average in retirement. In that case, you'd be better off paying less tax now versus more tax later on. Plus, a Roth account allows your investment earnings to grow tax-free, so you can make tax-free withdrawals in retirement, which could add up to massive tax savings on decades of account growth. All right, the second change applies to individual retirement accounts or IRAs. Unfortunately, the maximum you can contribute to a traditional or a Roth IRA will remain the same. It's $7,000 in 2024. It will also be $7,000 for 2025. And those over 50 can invest up to an extra $1,000 in additional catch-up contributions. That's also the same for 2024 and 2025. But there is some good news for IRAs in 2025. There will be an increase in the earnings threshold for deductible contributions to a traditional IRA. If you're a single taxpayer covered by a workplace retirement plan, you can deduct the maximum traditional IRA contribution if your modified adjusted gross income or MAGI is $79,000 or less. That's up from $77,000 in 2024. For married couples who file a joint tax return, the MAGI threshold for deducting the maximum contribution will rise to $126,000. That's up from $123,000 in 2024. There's also a positive change that will allow more savers to qualify for a Roth IRA in 2025. I always love that when more people can qualify for a Roth IRA. Singles with a MAGI of up to $150,000 and married couples with a MAGI of up to $236,000 can fully max out a Roth IRA for 2025, and that's up from $146,000 and $230,000 respectively for 2024. All right, the third change is coming to medical savings accounts. Some tax-advantaged medical savings, like a health savings account or HSA and a flexible savings account or FSA, will also have higher contribution limits for 2025. If you're enrolled in an HSA qualified health plan through work or even on your own, you can contribute to an HSA. You can invest the funds that you contribute for growth and then spend them tax-free on a broad range of eligible healthcare expenses. For 2025, you can contribute up to $4,300 to an HSA when you've got an individual health plan, or $8,550 when you have a family health plan. And that's an increase of $150 for the single plan and $250 for a family plan from the 2024 limits. Workers who have the option to enroll in an FSA can contribute up to $3,300 in 2025. That's a $100 increase from 2024. Now, unlike an HSA, an FSA has an annual spending deadline for emptying your account. However, for FSAs that allow unused balances to roll over, the maximum amount will increase to $660 in 2025. That's a $20 increase from 2024. So, giving you a little bit more money that you don't have to empty out at the end of the year. If you qualify for an HSA or have access to an FSA at work, those accounts can only be offered by employers. They're an excellent way to reduce your healthcare expenses. Some FSAs even allow you to pay for childcare expenses tax-free. The fourth change is coming to our federal tax brackets. In the United States, income tax rates are graduated, so you pay different rates on different amounts of taxable income. There are 7 federal income tax rates. They're at 10%, 12%, 22%, 24%, 32%, 35%, and 37%. Those percentage amounts remain the same in 2025. And with tax brackets, the higher your income, the higher your average tax rate will be. However, it's essential to understand that your highest tax bracket is not the rate you pay on all your income. You only pay the highest rate on the top slice of your income. And the IRS adjusts income within the tax brackets annually to avoid what's called bracket creep. This is what happens when your income increases, but you don't actually have an increase in real income due to inflation. For 2025, the tax adjustments allow you to earn more without moving into a higher tax bracket and actually paying more tax. So I won't go through all of the income limits for 2025, but just be aware that all 7 of them will be slightly higher in 2025 than they are in 2024. The 5th change that's coming is to the standard deduction. The standard tax deduction is a specific amount that reduces your taxable income based on factors like your filing status, like are you single or married filing jointly, and your age. But you cannot claim the standard deduction if you choose to itemize deductions on your tax return. You have to choose one method or the other, and you can choose the method that cuts your tax bill the most in any given year. For 2025, the standard deduction will rise. For singles, it's going up to $15,000. That's an increase of $400 from 2024. It will be twice that amount, $30,000 for married couples filing joint taxes. That's an increase of $800. For those who file as heads of household, the standard deduction increases by $600 to $22,500. In addition, those over 65 can take an additional standard deduction. For 2025, it will be $2,000 for singles and $1,600 per qualifying spouse. And if you're over 65 and blind, the standard deduction gets doubled to $4,000 for singles and $3,200 per qualifying spouse. So those adjustments are a $50 increase from 2024. So, Kareem, I hope that helps you do a little bit of planning to be able to really take advantage of these tax changes and updates. I would say maxing out a retirement account either at work or on your own would be a really great place to start. And then some of these other benefits are just kind of going to happen naturally. Like the standard deduction is just going to be a part of filing your taxes. But if you can increase deductions to workplace retirement plans, individual retirement plans, and any medical savings accounts that you qualify for, that is an excellent way to reduce your taxes and save more money. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast. I want to thank our terrific team. Steve Rickyberg audio engineers the show. Brandon Gachis is our director of podcasts. Holly Hutchins is our digital operations specialist. Morgan Christensen is our advertising operations specialist. Davina Tomlin is our amazing marketing and publicity associate. And Nathaniel Hoops is our marketing contractor.